All right. Joining me is Alex Thorn, head of Firmwide Research at Galaxy, who's a global leader in digital assets and data center infrastructure. And on the digital asset side, their platform offers institutional access to trading, advisory, asset management, staking, self custody, tokenization technology. I've said before, you might think of Galaxy as like the Goldman Sachs of crypto. They do everything here. And Alex himself heads up a team of researchers dedicated to the entire crypto ecosystem, which that obviously includes the regulatory side of the equation. And that's where we will be focusing our conversation this week, given everything going on with the Clarity Act. Alex, great having you back on the podcast. How have you been?
I'm well, Nate. Thanks for having me back. A lot has happened. I think I came on sometime in the maybe early spring or late winter of last year, very early in the 2025 story. But a lot of progress made in Washington for crypto as well since then.
Well, I always come back to what is it, 1 year in TradFi is like 10 years in crypto or something like that. And it certainly feels like that given everything that's gone on over the past year. So look, obviously I follow a ton of people in the crypto sphere, but I've got to tell you, I feel like you have been tracking the Clarity Act as closely as anyone. And so I did think you'd be the perfect person to really just help everybody understand exactly what this is, what's been happening here, why this is important, et cetera. I really want to try to help bring everyone up to speed on this. And so I thought, let's start with a few basics here, and then we can certainly get into more depth. Do you want to just explain what the Clarity Act is for people unfamiliar with this?
Yeah. So coming out of President Trump's reelection, crypto had a lot of goals, right? And without belaboring all of them, right? Two of the biggest from the legislative standpoint were codifying stablecoin, some kind of stablecoin, whether that goes in its own bill or whatever, and then also sorting out which types of tokens would be regulated by which regulators, when, how, and in which circumstances. So the former did culminate with the Genius Act, which is a comprehensive legalization and formalization of rules around stablecoins, and that was signed into law by President Trump July 2025. The second set of questions, again, the regulatory jurisdictions, how to handle different types of tokens, what is a security and what is a commodity, is broadly referred to as market structure, the crypto market structure bill. And progress didn't really start on this until late summer. The Senate Banking Committee released earnest progress. You did have the House pass a version of it in July, also called the Clarity Act. So that the House passed that in July, and it did have that delineation between the regulators and token types. It was pretty narrow in that sense, didn't have a whole bunch of other crypto things on it. Now, the Senate started working on it in August 2025. They released a very minimal, but a good start discussion draft. And then you kept hearing throughout the fall that they wanted to get it into committees to be voted on to advance to the floor in September. Then it was October. Then the shutdown loomed and everything got delayed. And then at the end of last year, the Senate Banking Committee said that they were going to do it in early January. And then at the beginning of January, Tim Scott, the Republican who chairs the Senate Banking Committee, set a date for the so-called markup hearing for Thursday, January 15th, which was last week. And that kicked off like a week and a half of negotiating flurry about what should be in this bill. Now, the one important thing to know is that I kind of described this bill as a Christmas tree. As you got stablecoins pretty narrow, and the House, insofar as that bill, the Genius Act, really only truly deals with stablecoins. And the House's version of the Clarity Act was also pretty narrow, mostly dealt with that jurisdictional delineation. However, in the negotiations in the Senate, a bunch of other equities came out and stakeholders to attach their interests for crypto sort of generally. And some of these are both advocates and critics of the crypto industry. And some of their asks aren't really related to that core market structure question, right? So should we add in protections for developers that are non-custodial, or how to handle which parts of the decentralized finance ecosystem are not decentralized enough to avoid having to comply with bank-like OFAC sanctions or, anti-money laundering rules. What about, should we relitigate the issue of stablecoin rewards? Can stablecoin issuers pay some of the yield they earn on the underlying collateral to the holders of their stablecoin tokens? So it kind of, a whole bunch of stakeholders had come out of the woodwork here and tried to add more things to it. So at its core, it's about, sort of protecting the crypto industry or clarifying for both crypto and TradFi from the regulation by enforcement attitude that the prior SEC had taken towards crypto. But it's become a much bigger fight over a bunch of different issues in crypto at this point.
Yeah, and I want to get into some of those sticking points and talk more about that fight. But just so I'm comprehensive here, what is the Responsible Financial Innovation Act? Because people will often hear
Yeah.
about that alongside the Clarity Act. So do you mind explaining that as
Yeah.
well?
Yeah. So Clarity, I forget that, it's one of these acronyms. It does have an acronym. That's the House version that passed in July 2025 during the House's Crypto Week, that also saw Genius passed and signed into law. That is that sort of narrow and core market structure bill, and it passed the House. So that's an existing text. If you search Clarity Act, you'll find on the House's website the actual text of that bill. Then the Senate the Senate Banking Committee proposed another version of crypto market structure called the Responsible Financial Innovation Act in August. It's mostly similar. There are some nuances even on that market structure core piece about how it's different. Primary difference, without getting too in the weeds, is a different way of calculating what would be a security and what would be a commodity than the Clarity Act took. Clarity Act sort of uses this thing called a mature blockchain test, whereas the RFIA proposed a version that creates two types of tokens, an ancillary asset and a network token. Fundamentally, it's not that much different. So that was sort of just the Senate working vehicle, but it fundamentally is similar to Clarity. In the end, basically, the way that these two interact is that the Senate Banking Committee was going to move the package in committee as the Clarity Act, but then do a whole substitution of the text of that to their version, which is basically from RFIA. The difference primarily is most likely if a market structure bill passes the Senate, it will actually be the text of this RFIA bill and not the clean text of Clarity. And then, if it passes the Senate, there'll have to be some reconciliation between the House and the Senate. But they're at the highest level, they're both basically the same idea. They just happen to be sort of two different legislative packages.
Okay. And again, we'll get into some more detail here in just a moment. But at a high level, I'm curious, why do you think this legislation is important? In other words, why should anybody care about this? And maybe you can take this from two different perspectives. I would say, number one, why should TradFi investors care about this? And then number two, why should people operating in the crypto sphere care about this? And I know, Alex, there are a ton of reasons here, but if you had to boil this down into some key points, what would those be?
Set the rules of the road. All right. Create rules. Right now, there aren't many rules. There's not. If you're a business even like Galaxy, and we sell a client, institutional or otherwise, like Bitcoin, who regulates our interaction, right? I mean, most crypto firms in the United States today are operating with money transmission licenses. So that comes with some regulation, no doubt, mostly around anti-money laundering stuff and, customer protection. But I think there's an interest for a lot of people, both on all sides of the issue, both crypto, TradFi, and opponents of crypto or critics of it, that there be more comprehensive rules, right? For exchanges, for brokers, for whomever. I think the question is, where's the line, right? Like, which ones should have regulation? So I think that both TradFi and crypto agree with that. I think TradFi wants the certainty of a regime that looks similar to the ones they're already following. If you think about whether it's a New York Stock Exchange or a major wirehouse or an asset manager, they'd like to know that there are rules that look similar to the other rules they're used to following. Perhaps, maybe even if they don't look similar, at least promulgated by the regulators they work with in financial markets, that give them the certainty that they can go forward and offer products related to crypto without somehow running afoul, right? There's not really a product that traditional financial services companies offers clients that isn't clearly regulated, right? So they'd like that clarity to give them more confidence to step into the market, which, is now a $3 trillion market. It's a market they want to be in, but they want that last leg of clarity. It's one thing if the, SEC chair isn't taking an overtly hostile stance. I mean, that's a positive, but they'd like additional clarity. I think crypto, They want that clarity. They're pretty satisfied, the crypto industry, with merely not being sued by the SEC, and that's a shorthand for they're satisfied with the administrative relief and interpretive guidance that they're getting from the market regulators that is not overtly hostile, but that can change, just like the posture has changed at, say, the Securities and Exchange Commission between Biden's SEC and Trump's SEC. So too could it change back, right? And so a major reason that the crypto industry wants some of these rules and concepts codified in federal statute is that that's much more durable admin over admin than just temporary regulatory relief or a change in posture.
Okay, so you mentioned this act or this bill that passed the U.S. House of Representatives back in the summer of last year. Again, it now sits in the Senate, where there's been all of this back and forth. And you highlighted a few of the sticking points. I'd love to have you go into some more detail on exactly what those sticking points are and how you think maybe they might be resolved. We saw Coinbase CEO Brian Armstrong come out and make some comments around being hesitant to support this in its current state. Just walk through some of those major sticking points.
Yeah, so like I said, the core concepts of, which is really Title I in the bill, if you were to go read it, about who regulates which types of tokens, when, how, and et cetera, I would say is mostly agreed upon by all stakeholders. And that's sort of the core of clarity. There are perhaps some sticking points here and there about definitions and whatnot, but in general, that isn't what has caused all the controversy, and it's not at the tip of the negotiating spear per se. Issues that have been added to the Senate version that weren't really germane during the House debate include stablecoin rewards. Like the Genius Act says, most agree, the consensus of the Genius Act language is that a stablecoin issuer couldn't pay rewards directly to a token holder under that law, but that perhaps they could incentivize token holders in some other way, such as through a platform. They could, for example, just pass the rewards to the platform, and if the user holds the tokens on the platform, then they could receive the rewards that way. People think, both supporters and critics of Genius and stablecoins think that is what the language says in Genius. And there's been an effort to relitigate that and make it more restrictive, add new language that further restricts issuers of stablecoins from paying rewards, whether that's to partner platforms, B2B, or B2C directly to token holders. Some of that's been driven by the banking lobby, which wasn't that active during the Genius debates, in April, May, June of last year, but has become very active in the Senate debates over the last couple of months. Broadly, they fear that if you pay rewards to stablecoin holders, it will cause further deposit flight out of the banks. Bank checking accounts pay almost no interest. I mean, literally like almost 0.00% interest. I think most of them, like Chase, will offer like 0.01% interest, right? So they're concerned essentially, and maybe this is a somewhat partisan way of saying it. They're concerned stablecoins could be too good of a product, and it could cause money to flow out of the banking system and into stablecoins. That's one reason why they become much more active, arguing for further restrictions on the use of stablecoins. And it's quite interesting what sort of the compromise looked like, and then why, where I think it may have been going, and why Coinbase said their support was they could no longer support the bill in its form last week. But I'll list off a few of the others. The how to handle DeFi, not really addressed in clarity. Should DeFi be regulated? If no, well, surely some things aren't actually decentralized. Maybe those should be regulated. In which ways should they be regulated? Should a DeFi app have to perform AML checks on the transactions that flow through it? What if they can't? What if it's so decentralized they have no ability to do that, right? How do we handle that? What about the developers of such decentralized or non-custodial applications? Are they responsible for the actions of those who use their software? These are questions to answer what I sort of broadly will call the DeFi and illicit activity issue. There are national security hawks, mostly on the Democrat side, but a little bit in the Republican side as well, who want additional protections or registration requirements, compliance requirements for certain types of apps that fall into those categories, to prevent terrorism, illicit finance, North Korea, et cetera. That has been an issue. And then sort of late in the game, one third issue I think that emerged that was interesting that caused some back and forth is what to do with tokenized securities. What level of power should the SEC have to grant exemptions to allow for the innovation and flourishing of a tokenized securities market versus doing notice and comment rulemaking? I think those are the big ones. I do think that DeFi/illicit activity and the tokenized securities question, we're probably heading in the right direction to not be so restrictive as to, be deal breakers for crypto. Even more so the DeFi issue, which the discussion draft that the Senate Banking Committee released on Monday night of the 12th or something, last Monday night. Monday the 12th. It had the Blockchain Regulatory Certainty Act, which protects DeFi and non-custodial developers in it. And it also had a clarification of the money transmitter definition, which clarified that to be a money transmitter, you had to control user funds. Those were pretty big wins on the DeFi and non-custodial dev protections front. It did give away a couple things, like it explicitly required certain front-end apps, like the DeFi web front end to perform OFAC sanction checks and stuff, although most agree that's actually already the law. And on tokenized securities, it didn't feel like that was going to break the wrong way. But it does seem that Coinbase and possibly just the stablecoin sector had sort of late Wednesday of last week decided that the direction that the negotiation was happening for stablecoins was unpalatable to them, and to the point where it may be a deal breaker. The discussion draft had a compromise. It said, okay, issuers cannot pay rewards solely to token holders solely for them holding the token. But it still had language that said they could incentivize based on activity. So an example, you could imagine, like, if you sign up for a Coinbase account, we can pay you $200, for the first $1,000 you transact in stables, we'll pay you, $45. Well, it turns out that's 4.5. That's 4.5%, right? Like, they could incentivize for transacting, opening accounts, settling, etc. Right? That was in the bill, but it seems like the opponents to stablecoin rewards wanted it even more restrictive, and it was sort of breaking in that direction. I think that's when Brian tweeted that they couldn't support it any longer. It's not quite clear that the others wouldn't have also ended up being deal breakers. This stablecoin rewards was the core of the deal breaker first, and it caused the Senate Banking Committee to decide to postpone the hearing. I think once Brian and others in the industry privately, Brian publicly and others perhaps privately, said they didn't like where this was headed and they would have to withdraw support.
So do you think some of these major sticking points can actually be reconciled? Like, I saw over the weekend something that the White House asked Coinbase to go secure a deal on yield. What might that deal look like? Is that going to be something palatable to the crypto industry? I'm trying to figure out, like, how far apart are we on getting to some sort of resolution here? It sounds like stable coins, that's probably the biggest issue. You mentioned some of the others. How far apart are we on these?
Yeah, I called it a narrow gap, but a deep chasm. They're not far apart. It's just not clear they can make that last. It's not clear to me that they can make that last, those last steps to reach the compromise on yield. Coinbase is a powerful lobby, both generally in Washington, but also in crypto. And it's just not quite clear. I mean, I think most of the crypto industry was prepared, and perhaps Coinbase was prepared to, although I can't be certain, was prepared to accept that compromise I said, where they couldn't incentivize just for holding, but they could perhaps pay rewards for other behaviors. It just didn't seem like that was going to be palatable to the Democrats and some holdout Republicans who want it to be more restrictive. So I honestly don't know if they can find a path through on the issue that can secure Coinbase and the stablecoin issuers while also placating the Democrats and these holdout Republicans on the issue. It's really not quite clear. I think they're going to have to get creative, maybe with tangential benefits for one side or another, that, while they don't get what they want on the core issue A, they get something else. It's honestly, Nate, it's not clear. It's really not clear. It's sad in some ways because, it's not all of crypto that really cares deeply about that issue, right? I think the most unifying issue in this bill, other than, again, the Title I stuff where we want the clarity of like, well, is this a security or a commodity, which everyone does want, but it seems like that's not really in contest at this point. It's really the DeFi and dev protection stuff that everybody wants. I think that could be a red line for all of crypto. It's not clear to me that stablecoin rewards are a red line for all of crypto. So there is an unfortunate scenario here where the bill simply cannot get passed because of an issue that not everyone cares about. I mean, I think it's important. We know that the administration cares about the rewards issue. They want Genius Act stablecoins to be really awesome US dollars, right? It's a huge part of their both treasury strategy and geopolitical strategy that the dollar-backed stablecoins become massive. And they know that the more restrictive the issuers have to be, the less massive it will become, right? So like there are, America First reasons to want the stablecoin yield issue to break in favor of the issuers. But on the other hand, like this would be a major overhaul of, think about a stablecoin almost like a money market with wings, right? I mean, no one with a lot of cash is sitting with their cash in a checking account. Everyone's already deposit flighted into money market funds or treasuries or something else, right? So I'm skeptical that deposit flight really is that big of a risk with stablecoins, but it is marginally net even better than a money market fund in some ways, right? So I don't know whether it can be crossed. I don't. I hope it will. We think it can still. I would say I'm net optimistic, but there's a lot of fog of war at the moment.
So let's say that is the case and they can't come to an agreement just from a pure legislative process. What would happen then from there?
Yeah, I mean, the calendar is a problem. There's not a lot of time in Congress. And, you're going to run up against the midterm elections very soon. There's going to need to be a budget resolution relatively soon, right? There's going to be, not budget, government funding is going to be an issue, right? You've also got other new issues, be it Greenland, tariffs, the 10% cap on credit cards that is going to start to dominate, I think, a lot of time on Capitol Hill. And just Senate floor time is very scarce. Like even if everyone agrees to move a bill, unless it's some kind of emergency funding bill, it usually takes at least 2 or 3 weeks, literally 2 or 3 weeks of time. So I would say the window here is closing. And if it doesn't pass, relatively soon in the next month and a half, probably in the Senate, if I had to guess, very unlikely that you see anything get out of Congress and sent to the president's desk on this in 2026. So what happens? Well, fundamentally speaking, not that much to crypto. Again, stablecoin issuers, if we agree on the consensus language from Genius, they can still incentivize and pay rewards, at least to some parties right now. We may not have specific clarity or overwhelming or comprehensive regulatory regime for digital commodity dealers or digital security brokers, or whether TradFi can touch tokenized securities. We might not have that now in law, but we mostly have progressive innovation thinking regulators, at least for the next 3 years. I would say fundamentally the downside risk for crypto is pretty low, whereas the upside is pretty high. But it is, it's those two things, like protecting against future rollback under a different regulatory regime, and getting that last final leg of clarity for traditional and crypto businesses to enter. Those are the positives. But yeah, I think just we're running out of time. There's just not that much time.
I know you said you don't know for sure what's going to happen here, but like, what is your base case? Or if you had to go place a poly market bet on what happens here, what would that be? We're not going to hold you to it, but I'm just curious, like, how do you think this is going to play out?
You hope for the best and you plan for the worst, Nate. I don't want to, if I was going to place a poly market bet, that's a good question. Well, I tend to bet on the pessimistic side of things because then, if the thing I want to happen doesn't happen, at least I win on the bet. I'm hedging emotionally. So yeah, I don't know. I think the path is definitely diminished. I thought it was, slightly more likely than not that it could happen before last week. So I'm going to put it at slightly less likely than 50 that it can happen. But people disagree. Even my boss, Mike Novogratz, remains optimistic. He thinks that he's net positive on it still happening. We won't know. I think we'll get more information maybe this week. Senate's in recess. And I don't think, today as we record on the 19th, it is a holiday. Maybe people are still taking this one last day off, but I expect Senate staff, administration, stakeholder negotiators to really start getting back into this tomorrow and this week leading into next week. The Senate Agriculture Committee still has a role here because there's what is a commodities issue, and Senate Ag oversees the CFTC, and they currently still have a hearing planned, the markup hearing on their version of the text for Tuesday, January 27th. That's 1 week from now. So presumably next week we'll see either some further advancement or maybe further postponement. We'll get more information as to the likelihood. I think by next week at the latest, you'll probably start to see some reporting coming out this week about where the sides are. But honestly, it's maybe a toss-up.
And going back to your comments just around crypto prices themselves, if I understood you correctly, let's say this is not passed through the Senate. It sounds like you don't think that'll be hugely negative for crypto prices. But I'm curious if it does. Let's say your odds are slightly off, and we're more positive here. We're more Mike Novogratz. And by the way, I'm not big into crypto price predictions. And anybody listening or watching here, this is clearly not investment advice. So let me just say that up front. But let's assume that the legislation passes in a form acceptable to the crypto industry at large. What could that mean for the crypto market itself in terms of potential price appreciation?
Yeah, a bipartisan agreement that crypto supports on market structure, if it looks like that is going to get to the president's desk and be signed, I think crypto trades higher. I mean, I would say Bitcoin, as an example, is in a clear downtrend from October to now. It hasn't quite broken out of it. This could be the catalyst. That could be the catalyst that does break you out and take you back over 100 and turn what is now resistance into support. That is possible. I don't think, instructive was last week when Tim Scott announced the postponement. Bitcoin and Ether traded down about 2.5%. Crypto-linked equities traded down much worse, 7 to 10%. I think it matters more. A negative outcome is more damaging to the companies that are centralized, that build in the space, than it is to the liquid asset prices, I believe, sort of from a fundamental basis. But yeah, I think in an abject failure, some kind of like failed vote. I mean, postponement forever that never gets taken up again is kind of like freezes the issue. It's probably the least negative of the negative outcomes, but an abject failure, I think, would be seen as negative for liquid crypto prices, definitely.
Okay, and then whether this happens in the shorter term or longer term, I always remember last time that you were on here, you made a really interesting point, which was that if we ultimately do get regulatory clarity, then it's actually going to be time for the crypto industry. You said to put up or shut up. You said crypto is like the dog that always barks and chases a car, but at some point, if it actually catches a car, will it know what to do? And obviously, you were referring to the crypto industry clamoring for regulatory clarity. And so if it actually gets it, will the crypto industry know what to do, right? Because there will be no more excuses in terms of proving its real world value in use cases. And so before I let you go here, do you still feel the same way? Or has that view evolved?
No, I definitely do feel the same way. And I think, even with Bitcoin here, I happen to take a longer view than some in the markets. But, again, we're looking at, geopolitical uncertainty and gold trading at all-time highs again, and Bitcoin underperforming. So even Bitcoin isn't quite doing the thing that it's built to do, at least in real time. I mean, it is up, 6x since January 23, whereas gold is up a meager 60+%. It's great for gold of an asset class. So even Bitcoin, I think, faces some of that test still. The rest of crypto, I mean, I think it's the same thing I said to you a year ago, Nate. Like, people want to own and they want to own Bitcoin. They like to use stable coins. I think that has a good product market fit. And I think sort of high quality DeFi applications have proven themselves. I think the core issue is the lack of high quality assets on chain. And there has been progress made in terms of tokenized securities as one part of that, improving the on-chain asset environment since we last spoke. more needs to be done. And I think there is movement at the SEC. If you listen to the statements from Chairman Paul Atkins, he's talked a lot about this. They seem very intent on supporting the growth of, innovation in equity securities in particular. I think we have made progress, but the crypto native narratives, whether it be Web3 or NFTs, or ICOs, or meme coins, creator coins, social fi, none of these have broadly gotten mass appeal. GameFi. So I do think it's true that crypto broadly lacks a killer app outside of Bitcoin, stablecoins, and DeFi. DeFi can be the thing that takes crypto to Valhalla, but it needs better assets inside. And here's the other thing too, is you've seen a lot of progress on traditional finance adopting crypto assets or crypto rails. Surely the assets themselves, we know that. I mean, you can buy Bitcoin, Ether, Solana at fidelity.com. You can buy ETFs that offer exposure to any number of tokens. But also you can possibly even borrow off of some of your tokens at TradFi firms now. And we saw announcements about tokenized securities from the DTCC and the New York Stock Exchange. So they're moving into our space a bit. I think we need to pull some of their assets onto our rails. And I think that's part of what people are working on. And there has been a lot of progress. I'm optimistic about that.
Well, perfect spot to end our conversation. Alex, I always enjoy visiting. You are clearly one of the best out there covering crypto and certainly the regulatory side of the equation. So thank you for that. And thank you for joining me.
Well, I appreciate it, Nate. Thanks for having me.
That was Alex Thorn, head of Firmwide Research at Galaxy. Hope you enjoyed this episode of Crypto Prime. As always, you can stay up to date on all of my latest guests by visiting CryptoPrimePodcast.com. Thanks for joining me.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. Some guests appearing on this program may also be financial sponsors of Crypto Prime. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit CryptoPrimePodcast.com for more information.